Low oil prices, how does that affect the markets? Do you know what a self-directed IRA is? How about 1031 exchanges? Did you ever wonder how capital gains are taxed? Sale of residence and the exclusion you can take for the sale of it. Folks, these are all things we're going to be talking about today, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, in this segment I want to talk about low oil prices and how specifically they affect the market. Now, I think it was just about last year we just became a net exporter, meaning we produce more oil than we consume in this nation. That's now allowing us to be energy independent. We are no longer relying on what's happening overseas and the like as far as it has to do with oil. Now, a lot of that, the reason we've become that is because of new technology. Now, I know this is very controversial with directional drilling and what they call fracking. I mean, this is literally with fracking, they're putting chemicals in to expand shale so they can, get more oil out. And I know that's controversial, but from a technology standpoint, it has certainly allowed us to ramp up our production. Now, low oil prices, for the most part, benefit anything that has to do with transportation. Airlines. I mean, it's tied to airline fuel, so that's a lower cost for them. Trucking. Anything that has anything to do with transportation where it's using fuel, it's going to be good for them for having lower prices. Now, who does it hurt? Hurts oil companies, right? Because when the price of the barrel is low and they're not able to get as much for their production, it hurts them. And oil companies who are not doing well and ultimately end up in bankruptcy, then that hurts banks, right, for the ones that actually loan to them. Now, in our country, we've got a lot of diversity. We're not like Saudi Arabia that's relying solely on oil production as a major part of its exports. We're pretty diverse here in the United States. Last I knew, the energy sector, the oil sector in our economy was like just a little under 4%. So that makes us very diverse. So even when that sector gets hurt in our economy and there's a loss of jobs and the like, it is still a very small part of the overall picture. Now, who really benefits from this? Well, consumers. I mean, you go to the pump. I think about a month ago when oil prices plunged down to $40 some a barrel, the price of gas got to be under $2 a gallon. I haven't seen that price in quite some time. And when you have lower prices and there's lower price at the pump, what happens? Well, you got consumers with more money in their pocket to spend on other things, right? And you got to understand, consumer spending is about 70% of our GDP. So when they've got more money to spend in other areas, that's obviously a good thing for our economy. The only thing I could say was bad is it was kind of a double whammy when it was happening alongside the coronavirus. But hopefully this gives you an idea, when it happened, how it kind of affects our market.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and I'll also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
In this segment, I want to talk about what's called self-directed IRAs. Now, if you didn't know this, you can actually hold real estate in an IRA. Okay, it could be commercial property, it might be residential property, it could be rental property, it could be raw land for that matter, but you can hold real estate in an IRA. Some other things that you can hold in a self-directed IRA are precious metals, gold, silver. How about cryptocurrencies? Okay, so a lot of people think that their IRAs just have to have, what we call typical mutual funds and the like, but actually can hold these kind of assets in them. Now, other accounts can have these kind of assets in them too. It's not just IRAs. Roth IRAs, SEP IRAs, simple IRAs, even 401ks can hold some of these assets. So knowing that might be valuable to you. Now, there's some rules that are associated with these self-directed IRAs though that you have to be aware of. First of all, the investments you put in them, it has to be what they call has to be an arm's length transaction. And all that simply means is that you can't have any personal benefit. So you say, Larry, what do you mean by personal benefit? Well, for example, let's say I put some vacation property, in that self-directed IRA. I can't have any personal use of that property whatsoever. Absolutely none. Let's say that I'm providing the management for that property. Let's say I'm mowing the lawn. I can't take any personal pay from that IRA either. Okay, so I can't have any personal benefit in that real estate from a pay standpoint or use standpoint. Now, if I got, let's say, rental property or vacation property in this self-directed IRA, all income and expenses have to be kept within that IRA. So rent income has to go in there, and then property taxes, insurance that get paid have to go out of there. So all income expenses have to stay in, and no personal benefit can come back to yourself. Now, if you want to do a self-directed IRA with real estate, you got to be careful because you can't have what's called any recourse debt. I mean, you can go out and get a loan with the bank to put it in, but the bank can't go after that property as collateral. It has to be what's called a non-recourse loan. So that's kind of a unique thing. A lot of times it's probably best if you can do these properties with cash. Now, do you have to have a third-party custodian? I know years ago one of the bank trust departments would be a custodian for these self-directed IRAs. I know now online you can Google for them. They've got these companies that act as a third-party custodians for these. Basically, they hold the title of the asset in the IRA for you. So hopefully it kind of lets you know kind of what those are about. A lot of people don't know they're out there, but if you're somebody that wants to get involved in real estate and you're in an IRA and you don't like what's going on with the market, then give us a call. We'll kind of show you how to get set up in one of those things accordingly.
Larry, that was really interesting. It makes me think of, these black swan event that we're kind of, been coming into here and what's happened with not only the virus, but also with oil prices. We have had this kind of almost happen overnight a month or so ago with all this coming to terms. And, there's so much information out there, but it makes me think about having a solid plan. We don't know when these black swans may hit us at any one time, and you can see really how quick they come upon us. And then when they kind of pile on each other, not only with the virus, but then the drop in oil prices, it's amazing how they can affect people's overall retirement plans. And I know for most of you out there, you don't want to rely on the markets to know if you're going to have income or the day you can retire. So all the more reason to make sure you have a plan in place that isn't subject to huge market fluctuations, so that all that savings you've been doing over life can generate a lifetime income for you in retirement.
Yeah, and that's where I look at, guys, a lot of times your asset allocation breakdown, like something that we review with our clients is, okay, what percentage of your portfolio has equity exposure or commodity exposure, like as we're talking about with oil, and looking at then your fixed income piece, or do you have any cash or other types of accounts that have principal protection? And so understanding the percentages that are broken out in all of those different areas and what that really means to you. So if you're looking at your portfolio and you see, well, wait, I've got 80–90% in equities. Well, yeah, you're going to feel those drops pretty significantly, but then you'll also be able to see those recoveries that much quicker. But if it's a much lower percentage in equities, then ultimately you're gonna see things. They're still going to move, but maybe not to the measure that you're seeing when the news reports, oh, we've had historic highs, lows, etc.
Yeah, Art, I loved what you were talking about, that black swan event. Actually, the black swan event was the coronavirus, right? All of a sudden, transportation slowed down to almost a halt, and then so demand went down. We had oversupply. You know, Saudi Arabia wanted to, start lowering production, but they couldn't get Russia to cooperate, and now everybody's in a price war. So, it was crazy how the oil prices plummeted. Anyway, stay tuned, folks, because in the next segment, I'm going to be talking about capital gains 1031 exchanges.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time we'll have reports that show us the percentage of assets currently in high-risk vehicles as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
In this segment, I want to talk about 1031 exchanges. Now, folks, 1031, all that's referring to is the IRS tax code number that talks about these. Now, in a 1031 exchange, what you're trying to do is defer the gain on the sale of, let's say, property. Okay, so let's say you bought this property for $100,000 originally. Now you want to sell it for $200,000. Okay, so you have $100,000 that you want to defer. In a like kind exchange, you have to buy, for it to be effective, you have to buy of equal or greater value. So for me to defer that $100,000 gain, what I want to do is buy another property for at least $200,000 or more. Now, by doing so, that $100,000 deferred gain gets transferred over to the new property. So let's just say, for all practical purposes, I exchange it for some property worth $220,000. Now my basis in that new property is $120,000 with a $100,000 gain starting with day one that'll have to be paid down the road when I sell that property. Now, I have to be careful because I can't incur any new debt when I do one of these kind of exchanges. That'll create what's called boot and then can make some of it taxable, so you got to be careful of that. I have to use what's called a qualified intermediary. What the qualified intermediary is going to do is going to hold the proceeds from the first sale, and then they're going to hold them towards the purchase of the next sale, where you can't receive any of the proceeds. Okay, it's going to be very important. And there's actually what they call a qualified intermediary agreement that has to be part of this arrangement as well. So they effectively they hold the proceeds, and then they try to make the sale happen properly according to the rules. Now, the property must be like kind. You know, it has to be, if you're doing real estate, it's going to be real estate you're going for. You have to be able to identify that property that you want to exchange for. You have to identify it within 45 days of the close of the property you just sold. So you sell the property for $200,000. Now you've got 45 days to get out there and try to find where you're gonna, what property that you're gonna purchase. Now there's different ways you can identify these properties. You can identify 3 and then maybe just close on the 1. There's some other ways you can identify a number more properties, but you have to meet certain rules. Now, all that being said, you identify the property within the 45 days. Now you got to close on that property within 180 days. So folks, as this is something that you'd like to maybe look at or do, it can be very valuable, but it comes with some very tight restrictions or rules associated with it that you're going to want to know about. If there's anything like that we can help you with, then give us a call.
Hi, my name is Jack Clunder and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
In this segment, I want to talk about capital gains, most particularly how they're taxed. First of all, a short-term gain is one in which that you buy a security and you sell the security within a year. If you do that, it's considered short-term and it's subject to what you call ordinary income tax rates, basically whatever bracket you're in. Okay? Now, if you buy a security and sell it in longer than 1 year, okay, now it's considered a long-term gain and it gets taxed depending on what your income is. Okay, if you find that gain is entirely in the lower bracket, which would be the 12% bracket, then it gets zero taxed. If it falls outside that bracket, then depending on your income, it can be 15 or 20%, but that's all. That's the maximum they can charge you on those. So great benefit if you can try to realize those gains in a lower bracket. Now, a lot of times at the end of the year, you'll get these statements and it'll show you these unrealized gains on your portfolio statement. Okay? Now, all that is that these are securities that you've purchased, you've held, but they haven't been sold. And understand, you're not going to pay tax on them till you sell them. So tax harvesting can be very valuable where you're going in maybe at the end of the year and you're trying to sell off some of the positions with gains and then maybe offset it with some that have losses. So recognizing where you're at in that in tax planning is going to be beneficial. Now, if you inherit an account that's got a lot of unrealized gains and it's a non-qualified account, which just simply means it's a non-retirement account, you enjoy what's called stepped up basis, meaning you can pass those on to your heirs and they get to step up the basis to the fair market value upon your death. So there's cases where you can have these unrealized gains and no gains are ever going to be paid on. Again, you can offset losses with gains. So if you can look at that and try to tax harvest that in an appropriate rate, going to be highly valuable. Now in IRAs, you don't have to worry about it because there is no capital gains. Basically, every dollar you take out of an IRA is going to be taxed. Now, on rental property, you got to be real careful because all that depreciation you took over the years, that has to be recaptured, and the rate is 25%. Collectibles and coins, 28%. And then folks know this, that there's a limit on on the net losses you can take in a year. For a married couple, that's $3,000, but you can carry them forward indefinitely. For single people, that's $1,500. But what you don't use, you can carry forward indefinitely. So folks, if you're somebody that maybe has some of these kind of positions, you don't really know how to tax harvest them yourself, want maybe a little bit of tax planning to help you with that, then give us a call. We'd be glad to help you.
Thanks for bringing that up, Larry, as far as with real estate, with investments and after-tax brokerage types of accounts and those gains that you may be realizing if you sell those investments. And so Art actually had this really good point. So I got to give Art credit for this, but it's like you're putting the cart before the horse, right? Is what you're talking about. And so it's looking at, okay, are you going to make a decision solely based on the tax ramifications, not even considering what the whole investment piece of this is? And so you may have had a great success in realizing a number of gains on this investment, but are you going to say, well, I may not take action because, well, I've got to pay taxes on that? And so that's something that we come across actually quite often.
You know, John, it's interesting. You're right. I mean, that's why we focus so much on tax planning and why it's so important. But you're right. So often we've had people come in and they're making their whole investment or really livelihood decisions based on the fact that I don't want to pay taxes. Well, none of us want to pay that. But the one thing is, especially when we come to capital gains, usually that means you've made money, right? And we've seen people actually make bad investment decisions only to not pay taxes. Well, guess what? Then you may not have to worry about paying taxes because you went lost the money. So, you know, obviously with the focus on tax planning, we don't want to underestimate that, but also there's more to that picture, and we have to walk through that in individual circumstances because, you know, we want to make sure you're doing what's best for you.
Yeah, guys, you mentioned tax planning, Art. You know, a lot of times we'll have these clients that got these unrealized gains, right? Gains that they haven't sold, and they'll have some room in that lower tax bracket. And so we'll have a plan to every year try to maximize that lower bracket by realizing these gains where they're not going to pay any tax. Huge advantage, right? To getting those, you know, that tax out of the picture. So tax planning is a big issue. Folks, if that's something you find valuable or want to have that you're not getting with your investment management team, then give us a call. We'd be glad to sit down with you, not only look at your investment management and how you might be structured, but what's your tax plan? You know, maybe there's a Roth conversion opportunities, maybe there's gains you need to realize and need to, what we call tax harvest. So if that's you, give us a call. We'd be glad to meet with you. Now stay tuned, because in the next segment, we're going to be talking about sale of resident exclusion. So stay tuned.
We look forward to helping you plan to retire well.
In this segment, I want to talk about the sale of a residence exclusion. Now, if you didn't know this, if you're a single person, you can exclude $250,000 in gain, and I'll show you how that can happen. If you're married and you file a joint return, that exclusion is $500,000. Now, folks, remember that's on the gain. So if I purchased a home for, let me use round numbers, and I don't know, this isn't all homes, but let's just say I purchased a home for $500,000, and I held it for a lot of years. I then sell it for $1 million. I've got a $500,000 gain there that can be totally excluded if I'm married and I file joint. Now, under the old rules, years ago, if this might date you, if you still remember this, you had to buy or build of equal or greater value when you went to a new home. And as long as you continued to do that, you could keep deferring the gain on that home. And then when you reach the age of 55, you could take a one-time lifetime exclusion and not pay any tax on the gain. Well, folks, that's all changed now. Now the way they do it is when you go to sell the home, they're going to look back 5 years, and if you lived in it, the equivalent of 2 years. So they don't have to be consecutive. You just have to show that you had the equivalent of 2 years as your principal residence. Then you can take that exclusion I was telling you of $250,000 or $500,000. Now, you can do this every 2 years. Let's say that, and this might be a plan, let's say you got a second home or a vacation home. You go sell your principal residence, okay, take the exclusion on that, and then go live in that second home or that vacation home for 2 years, satisfy the principal residence. Now you can turn around and sell that 2 years later and not pay any tax on that as well. Now, you got to be careful because one area what people wanted to do this in is with what's called rental property. They've been depreciating it for years. Now they got this low basis. When they go to sell the rental property, it's going to have all that depreciation has to be recaptured. So they wanted to move into these rentals to satisfy the 2 years and sell them. Well, IRS got wise to that, and so now what they've done is they limit the exclusion. So let's just say that you've owned this property for 20 years. Yes, you lived in it for 2 years. Well, they're going to take that 2 years, divide by the 20, 10%, and then they're only going to give you 10% of that exclusion amount, which would be $25,000 or $50,000, right? So, you got to be careful. If you got rental properties, it's not going to be easy to do it. Vacant land. You might have had a large piece of land contiguous with your own home. As long as you enjoyed that land as part of your home, you can sell it off separately. You just have to make sure it's done within a 2-year period and both enjoy that exclusion. How you calculate the sale, you just take the sale less your original purchase, less the improvement you put in, less the closing costs from the sale, and there you go, you've got your gain. And then if you subtract the exclusion from that gain, if there's anything left, you've got taxable gain. So hopefully you found this valuable. If it dated you, funny if you remember the old rules, but try to remember the new rules. Now guys, I remember those days because I had my own tax and accounting practice, and in those early days, I mean literally people were having to keep receipts. They'd buy this home, they'd keep the closing documents, and then any improvements they make, they're keeping all these receipts, and it was nuts. They'd have to keep those, then get another house, and then keep all the receipts on that, and this all had to be accumulated and kept until they got to 55, and then they could take this one-time exclusion, but a lot of paperwork. I'm so glad now that's gone. Those days are gone. But Art, what did you think of that? Do you even remember that old tax law?
No, I mean, for sure. Was that were you chiseling stuff on little concrete pads at that point, or? No, it's interesting, Larry, you bring it up. And I think of, in this show, we've talked about a lot of different topics, and the one thing that comes to my mind is the holistic approach. Here at Centennial Wealth Advisory, we plan for you to retire well. And there's so many different aspects to that plan that come into play. Larry's went into detail about these primary home exclusions and capital gains and 1031 exchanges. It's not just your 401k or your IRA. Remember that there's so many moving pieces to this puzzle that effectively need to be taken care of and considered. All these things like your home should be considered an asset. That's a lot of people have a lot of money into their home, and that's an asset. And how can you treat that? How do you best benefit you over your lifetime and your family?
Yeah, and that's where I just want to encourage you as you've been watching the show today, or maybe you've been watching the show for a number of years, and at Centennial Wealth Advisory, our goal is to help you plan to retire well. So we strongly encourage you just to give us a call. We'd be happy to sit down, no cost, no obligation, and just better understand where you are, what your goals are, and try and help you accomplish those goals. So thanks again for tuning in to Retiring Well.